I'm Perry Sykes, and welcome to the Investor Resources Podcast. Today, we're going to talk about some of the things that can have people misbehaving in volatile markets, and we do have those right now. Volatility is greatly heightened. We have volatility in markets, government policy, in trade, supply chains. It all translates into emotional volatility. So we're going to look at some of the ways that these things manifest themselves, and they impact us all in some way. You've probably heard of all of these conditions, many of them psychological. We just want to make sure you understand what they are and to give you some extent a little control over how to control them a little bit. Start off with recency bias. That's when you give more weight or importance to recent events, such as stocks are up, meaning the correction must be over, or stocks are down, this downturn will never end. There's a tendency to declare victory, either bullish or bearish, when the stock market is rising or falling rapidly. And the volatility plays head games with you. It makes you make these decisions too quickly and usually right at the wrong time. Loss aversion. Loss aversion is one of the most important concepts in finance. It says that losses hurt twice as bad as gains make you feel good. So the 10% correction we had previously makes you feel twice as bad as the 10% up day we had last week. The gains don't have a chance against the losses when it comes to your emotions, and that causes many, many mistakes. The more often you look at the market or your portfolio, the worse you're going to feel. This is always true, and even more amplified during volatile markets. Confirmation bias comes from seeking opinions or data that agree with a pre-existing belief. So with the internet and 24/7 news, social media, it's never been easier to seek out only those opinions you agree with. It's a very dangerous thing. If you want a bullish take on the market or the economy or a stock pick, you can find it. You want a bearish take on any of those, you can find that too. So when markets and emotions are all over the place, it makes you feel better to seek out opinions that match your own. And those opinions can be useful if they help you stick to your investment plan, but they cannot help predict what comes next. That's the important part. The stock market doesn't care about opinions, just facts, data, and trends. Nothing else matters to the market ever. Anchoring. Anchoring is when a default starting point influences your conclusions. Investors often anchor to a stock's cost basis or an all-time high or a low or the last price they saw. Making investment decisions during volatile markets tied to those specific price points can cause problems. You start with, I'll just sell when I break even. So that break even point becomes the decision maker. I can't buy that stock now. Look at where it was trading during the downside, when in the middle of the correction. I can't buy that now. Sure, the market's down 15%, but I'm not buying that till it's down at least 30%. So obviously, the price you pay for an asset matters. But investment decisions shouldn't be held hostage by an arbitrary value. You've got to have other metrics that you're looking at, not just an exterior driver like whatever the cost happened to be the day I decided to buy. Hindsight bias. That's the assumption that the past was easier to foresee than it actually was. It happens all the time. Hindsight's always 20/20, but never in the moment, only looking backwards. Whatever happens in the trade war right now, well, will look obvious in hindsight. You're going to be saying, oh, I knew Trump was going to slap tariffs on everybody on everybody on earth. He told us that in the campaign. Or it's going to be, I knew this was all just a negotiating tactic and it was all going to blow away. However it plays out, it's going to feel obvious to everyone. And a lot of people act like they knew it all along. So I don't know how or when the current volatility will subside, of course, but I do know a lot of people will pretend like they saw it coming from a mile away after it happens. Next, endowment bias. And this is another good one. It occurs when you place a higher value on something you already possess. The stocks I own, they're all undervalued. The stocks everyone else owns, they still have a long way to go to reach their fair value. So this is the reason homeowners have a difficult time making price cuts. You always think the thing you own is worth more simply because you own it. It's one of the reasons I always say in trading rules and strategies, nothing matters until you have some skin in the game, because you act differently when your money's on the table. And you need to have it in there, and you need to be considering that as you make decisions. The gambler's fallacy that exists when you see patterns where none exist or sequences in random events. This is your buddy at the casino who thinks red has a much better chance of coming up on the roulette table after black hits a few times in a row. So they think they know what's going to come next based on what has just happened. The stock market was down yesterday, so it's going to snap back today. Or the stock market was up yesterday, so it should keep going up tomorrow. Now, momentum in the stock market exists, but most short-term moves are just random. They're nearly impossible to predict. So banking on that doesn't make any sense, but people do it all the time. How about the illusion of control? That's the belief that you have control over uncontrollable outcomes. Many studies show people are willing to pay 4 times more for a lottery ticket if they can pick the numbers rather than have a random selection. The odds are the same either way, but people like that feeling of control. Investors have a tendency to grab the steering wheel to take more control during market downturns, thinking they can actually do something about it. Doing more often leads to bad returns. Sometimes you should just leave things alone for a bit, especially when emotions are running high. You don't want to make those decisions when fear and greed are the two biggest things in your head. The sunk cost fallacy. Hear about this one a lot. That's when your decisions are determined by investments that have already been made. If you were starting from scratch today and your entire portfolio was all cash, would you still own the same mix of assets? Or would your portfolio look entirely different? Sometimes you hold on to investments simply because you already bought them. And you think, well, that must have been a good idea, so I'm not going to do anything about that. Same is true of just investment opinions. People often hold on to certain views too long and won't change their mind simply because it required a lot of time and effort to come up with those views in the first place. And this leads to more confirmation bias when there's evidence to the contrary. Even when there's evidence to the contrary, you will not look at it. You will not change your behavior because you are just hanging on to the last thing you thought of. There's a laundry list of behavioral biases that we all succumb to, and they can all lead to regret as investors. And research shows that investors hold on to losing stocks too long in hopes they'll come back to their original price while selling their winners way too early. Investors also anchor to recent results. So initially, markets underreact to news, events, or data releases. And then on the flip side, once things become more apparent, investors are prone to that herd mentality and they tend to overreact. And you can be a loser on both sides if you're hanging on to either one of them. This is what causes markets to overshoot in either direction. We're way too oversold, or we're just buying way too much, as that pendulum between fear and greed and overconfidence and confirmation bias swing back and forth. They lead investors to pile into winning areas of the market after they've risen or pile out after they've fallen. It's all interrelated depending on your actions, reactions, and emotional makeup. The worst bias is typically the one you see in others but fail to recognize in yourself. That's a big one. We all need to look in the mirror and see and ask ourselves honestly, are we doing any of these things with what we're doing with our investment strategy? Everyone has a lesser version of themselves, and you need to watch out, especially when volatility strikes. That's why an investment plan is so important during times like these. Human nature is out to get you, and believe it or not, we are all human. That's why at Investor Resources, we have rules-based, data-driven portfolios. We have rules. When we buy a security, we already know what's going to occur to get us to sell it. And when that comes to pass, we sell it, whether we like the idea or not. And when things show up in our investment decision matrix that say these things should be a buy, and we're looking at it, shaking our heads, thinking that doesn't seem like a very good idea right now, we do it in spite of what our feelings are. That's the discipline part you have to have in a rules-driven portfolio. You have to be willing to follow the rules. It's going to lead you places sometimes you're not comfortable being. That's the point. The point is, there's an old saying in investing, what's comfortable is rarely profitable. And that's true for all of us. It doesn't matter if you've been doing this for 50 years or if you started a few days ago. You're not going to feel comfortable doing things from time to time. And most of the time, you need to follow the rules, follow the data, follow the trend, follow the money, and do not follow your emotions. I hope some of these struck you today. I hope some of them will help you see some of the things that can happen, especially in times of high volatility. And never forget, markets that are going up rapidly, that's just a volatile market also. People don't look at it that way because we really love that up volatility, but it can lead you to decisions that are just as bad as panic selling on the downside, which can just decimate a portfolio. We'd love to give you a second opinion on your portfolio, what you're holding now, even after all this volatility has come to pass. And if you'd like us to do that for you, it's a complete freebie. You just send us an email. That information is going to come up on the screen here. Send us an email, and all we need is a list of the tickers in your portfolio. It doesn't matter how much. We just need to know what you're holding, and we'll give you our opinion about whether that's something that should still be in your portfolio, or maybe something you should have already let go of. If you enjoyed this podcast, feel free to subscribe. Make sure to hit that subscription button, and we'll see you down the road. Thanks for watching today. Take care.